Good to go. Okay, great. So this paper is with Zhang and Tony Jiang, who are both here if you have any questions. Let me just start off here showing you the trend that we're actually interested in here. If you look at the US's net foreign asset position over, say, in our particular case, the last 20 years or so, you'll see that there's been a large decline in the aggregate net foreign asset position for the US. These are portfolio positions primarily because of data constraints that we're working under. But you can see here going back to 2002, as a percent of 2002 GDP, the US net foreign asset position was about minus 10% at the beginning of the sample, and this has declined to about minus 35%. Now you can break this down into the different components. In particular, we can look at this as the net foreign asset position in equities or long-term debt and short-term debt. And what you see is that within the US's portfolio, they run actually a positive asset position relative to their foreign liabilities in terms of equities. The main driver of this trend over the long run has been the decline in the long-term debt position of the US vis-a-vis the rest of the world. In this paper, we're going to be interested in studying this trend, which has been a kind of a key focus in the international macroeconomics and finance literature for over recent periods. Now, what are we trying to do? Look, there's large differences here between the foreign asset and liability positions in the US as well as other developed countries. We'll be very interested here primarily in the US, but we could extend this to study other developed countries. Indeed, the data is actually there in the underlying approach that we're going to take. Now, work by Hélène and Pierre-Olivier, for example, has suggested that these imbalances have been driven both by quantities and price adjustments. And I'll come back to this later, but in the context of our setting, we'll see that having downward sloping demand curves will allow us to think about nice ways to decompose how changes in quantities of positions held by countries endogenously affects the prices. Well, the literature has suggested a number of potential explanations for this decline in the US net foreign asset position that we've seen. We're going to break them down into three different categories. So these are kind of rough categorizations of what the literature has suggested. The first suggested reason for this decline in the US net foreign asset position is this global savings glut. Indeed, going back to a speech by, for example, Ben Bernanke in 2005, which suggested that foreign investment opportunities were not as prevalent for these foreign investors. And so there was a global savings glut that drove foreign investors to purchase US-based assets. The second explanation goes to studying the official holdings, both of foreign central banks as well as the US Federal Reserve. Over the last decade, for example, we've seen large increases in quantitative easing, as well as changes in reserve positions of foreign banks. And a third explanation for this trend in the net foreign asset position was shifts in demand of investors globally. Indeed, there's been a large literature that has studied demand for safe assets as well as changes in risk-bearing capacity of different investors globally or different issuers of assets globally. And so the goal of this paper is going to be to actually decompose this change in the new net foreign asset position into these various components using a structural framework. So the challenges up to this point with the literature is that there hasn't been a joint quantification of how much these various forces matter. Now, to account for kind of this rich structure of substitution that occurs globally, we're going to need a number of things. We're going to build on a framework, as Matteo suggested, that's going to allow us to use holdings data, in particular bilateral holdings data of countries globally. This will allow us to estimate a demand system where we have rich substitution between within asset classes. So you can imagine an investor investing in equities globally, they'll substitute across different countries, as well as substitution across asset classes, that is across debt versus equity in this system. Now, importantly for this point that I made about quantities and prices is that in this setting, asset prices and capital flows, or the quantities held, are going to be endogenous. When you have imperfect, if demand isn't perfectly elastic, then any changes in quantities will actually endogenously affect prices. This will be an important component in our setting, which will allow us to further understand what has driven this change in the net foreign asset position of the United States. All right, so what specifically is our approach? We're going to use a demand-based asset pricing model to understand this long-run variation in the US external portfolio. we're going to add on a couple of key components here. One of the key components that we're going to have is we're going to have endogenous wealth dynamics. Indeed, we're going to allow for endogenous adjustments of investors' wealth to the capital flows that occur in this system, as well as to other changes in the underlying demand curves.
Oh, hi, Rob. I think the slides are frozen.
They're frozen. Okay, let me check.
Yeah, we're still seeing motivation.
Oh, that happened. Can you see that now?
Yep.
Okay. Sorry about that. I don't know what happened. Okay, so what are going to be our main findings here? The main headline number that we're trying to study, as I showed on the first slide, was this decline in the US net foreign asset position, at least in their portfolio position, but it also occurs across other components of the aggregate net foreign asset position. Here we're going to be looking at this decline from minus 10% of 2002 GDP, which was about $1 trillion, to minus 32% of 2000 GDP, which was the decline to about 3.5 trillion US dollars. Now, one of our headline results is going to be that the savings glut alone suggested that US asset portfolio position would have declined by 76% of 2002 GDP. So the exercise here is going to be keep all of the other constituents of the demand system constant, that is demand with respect to particular characteristics and all of these, and just allow changes in quantities invested versus assets issued and see what the counterfactual change in US net foreign asset position would have been. And this would suggest that this would have been minus 76% of 2002 GDP. We're going to show that the vast majority of this effect actually originated from growth in developed market savings. Beyond that, we're going to add on changes in official holdings. So we saw large changes in reserves as well as quantitative easing by the US Federal Reserve. If we add on this additional component of changes in the official holdings of central banks, we would have seen that the US portfolio position would have declined to actually minus 94% of 2002 GDP. In the paper, we show that there was significant spillovers between the central bank purchases of debt to the actual equity prices that occurred. And this is happening because demand curves are imperfectly elastic in our system. Now, how do we get back to this minus 32% of 2002 GDP that we saw in the actual data in this trend? Well, we're going to show that this final component of changes in demand, I'll be specific about this in just a second, this is actually going to offset these changes that we saw in the global savings glut as well as the official holdings and put us back to the minus 32% of 2002 GDP. And so a key takeaway from the paper is going to be that by using this structural system and rich data on portfolio holdings, we're going to actually be able to decompose this trend into various components and see that underlying the simple trend in global imbalances lie various forces that go in different directions. All right, I'll just briefly kind of highlight the related literature here. There's a large literature on drivers of net foreign asset dynamics. We're going to take kind of a finance perspective and use a portfolio choice approach to study some of these changes in net foreign assets. We're going to be contributing to and building on the work in demand system-based asset pricing that has been mentioned a number of times. We're going to use this kind of finance perspective on this to try to answer a question about quantities, and in particular the net foreign asset position, which is a big question on the international macro and finance side. We're going to be able to contribute to this literature on unconventional monetary policy to understand how quantitative easing and other changes in reserve positions has affected the US net foreign asset position. All right, so let me set up the framework here, and then we'll talk about estimation. So there's going to be N countries which issue assets. There's going to be 3 asset classes. They're going to be labeled 1, 2, and 3. Asset 1 is short-term debt. Asset 2 is long-term debt. Asset 3 is equities. Each asset class contains an outside asset, which is going to be indexed by 0. And then there's going to be some evolution of the quantity supplied of asset N in country L. Right? So there's N countries, they issue assets. Those are labeled by N. The quantity issued is QT, or the quantity outstanding is QT in that particular asset class. And it evolves according to some exogenous process. Right? It just evolves at the time T value, and then there's some change between time T and T+1. And there's going to be I investor countries that can purchase all of these assets. These investor countries are going to allocate some assets under management, which is labeled AIT. So how does the demand structure work in this setting? There's going to be some weight that investor I puts on country N's asset in asset class L. It's going to have two components. It's going to have some portfolio weight conditional on investing in that particular asset class L, and then it's going to have some portfolio weight across asset classes, right? So this is the total portfolio weight on equities, debt, or long-term by investor I. Okay, how is the portfolio weight within asset class L structured? Well, conditional on investing in asset class L, that portfolio weight is going to be a logistic function that is going to be a function of a few critical things. Why is it a logit? Well, if you look in the data, the portfolio weight distribution is approximately log normal. This ensures that these weights sum up to 1 here and gives us something that's tractable to actually estimate that data. How do we specify this function delta? Delta is a function of expected returns in investor I's own currency, as well as some asset characteristics and some latent demand, which is unobservable to the econometrician, but is used so that we perfectly fit the cross-section of holdings that we observe in the data. Just a side note, you can derive this functional form as a function of characteristics if the characteristics themselves are good proxies for, say, riskiness and growth rates of some returns on the assets. You can see this in Ralph and Moto's previous work. Okay, so we're going to use a nested logit for cross-asset substitution for this portfolio weight in asset class L. There's more details on that in the paper. Okay, so a critical addition that we're going to add on to what is kind of the standard demand system asset pricing at this stage is we're going to have some endogenous assets under management for each of these investors. Well, the assets under management of investor I at time t is equal to whatever their AUM was in the previous period. And now you just need to consider what the portfolio weights were on, say, asset K. You're going to have some gross return that was obtained between time t minus 1 and time t on that asset. This return is endogenous. When demand curves are downward sloping, an increase in the purchases for a particular investor's asset is going to increase the price of that asset. So we need to take into account this endogenous return. We're also going to have flows. So investors can add more assets into the system. They're going to distribute those assets based upon their demand functions. We will have some exogenous flows that allows us to understand how, say, increases in savings has affected the net foreign asset position in the system. Then we're going to need one more equation. We're going to have a market clearing equation that just says the total value, right, price times quantity of each asset N, or country's asset N, is equal to the total demand by all of the investors plus the total demand by the central banks. BIT is just the quantity demanded of the central banks. Okay, so what is the data we're going to be working with? We're going to be working with the IMF's Coordinated Portfolio Investor Survey. So this is the first reason that we're constrained to going back to 2002. This data only goes back to the early 2000s. I want to flag again that what we're studying here is the portfolio positions of countries. There's also this additional component in the aggregate net foreign asset position that would include things like FDI or bilateral bank holdings. We're not studying that here. Our investors include banks, corporates, and households. And governments, excluding central banks, though, we're going to use this data from the SEFER, which gives us aggregate holdings by central banks of particular assets. And we'll use data from the US Federal Reserve to understand holdings of US assets by the US Federal Reserve. Now, it's become kind of well known that there's issues with residency versus nationality in this data. So work by Matteo, Jesse, Brent, and Antonio has shown that financial tax havens can distort this data substantially. What we're going to do here is we're going to use their reallocation matrices to redistribute holdings based on nationality. And for numerous reasons, we're going to combine the EMU to be a single investor country. One last point on the data. The CPIS doesn't allow us to observe domestic holdings directly. What we're going to do is we're going to take the total market cap of a particular country and subtract off the aggregate holdings that we observe from the CPIS to impute domestic holdings within a country. All right, we need some asset characteristics because the demand curve here is a function of asset level characteristics. We're going to use some characteristics that have been shown in the literature to proxy for both currency and macroeconomic risks. So we use GDP per capita, we'll use a measure of trade network centrality. We've got numerous measures of macroeconomic risk, so GDP, we've got inflation, sovereign default probabilities, and we've got some bilateral variables, bilateral trade exposures, distance, and stock market volatility. Asset prices are going to be market to book ratios for equity. We'll use 10-year government bond yields for long-term debt. We're going to include a US destination dummy to capture the fact that there's a large literature showing that the US and dollar-based assets have particular characteristics that investors demand. So we have 43 investor countries, 36 issuer countries. The data runs from 2002 to 2016. So how are we going to estimate this? We're going to follow the literature on demand system asset pricing by Ralph and Moto. You can see if you take logs of our portfolio weight function that in logs, this is linear in expected returns, which we estimate using a forecasting regression with prices and exchange rates in there, as well as the characteristics and latent demand. Now, as soon as you're estimating a demand curve with portfolio weights on the left-hand side and something with prices on the right-hand side, you're worried about endogeneity concerns. Why is that? Well, you could have a large investor that has a particular affinity for an asset class. That is, they have a large kappa for that particular asset class. That would mean they have a large portfolio weight there. But with downward sloping demand curves, this high latent demand will also influence the price of the asset, which shows up in this expected return here. And so it's possible that there's an endogeneity concern, so you need an instrument for this expected return. What we're going to do is we're going to follow the previous literature. We're going to use the structural model, and in particular, the market clearing equation, to estimate implied instruments. What do? We estimate this equation, but just with sets of characteristics that we can take as plausibly exogenous here. We use kind of very, very persistent set of characteristics, GDP, distance, just an investor fixed effect, to estimate counterfactual portfolio weights, assuming that we just used those instruments. And then we use the market clearing equations to compute predicted portfolio weights, which are W hat, which gives us an instrument in the cross-asset regression. And then we also use the demand system and the market clearing to compute counterfactual exchange rates and prices that clear the market, which eventually gives us instruments for this expected return here. How are we going to do that? Okay, so we've got all the estimates in the paper in more detail. What I want to show you here is just a few of the key coefficients and highlight some of the estimates of the within asset demand. The cross-asset demand parameters are shown in the paper as well. What you see here is that conditional on characteristics, investors prefer assets that offer higher expected returns. Indeed, this implies that investors exhibit downward sloping demand curves. You also get reasonable coefficients on some of these measures that are representative of riskiness of assets, things like GDP and centrality here. All right, now what I want to do is kind of get to the key results of the paper. Let me just first talk you through what the exercise that we're going to actually study here is. Here I've put the key equations from the paper all onto one slide here. The first is the assets under management evolution. The second is the market clearing equation. And the third is portfolio weights. Now, on this slide, what I've done is set all of the exogenous variables to be in black font and the endogenous variables to be in red font. Okay, so exogenous variables are things like central bank holdings, the flows into the system, as well as the supply of assets here. Endogenous quantities are things like the portfolio weights, the actual prices. And so how are we going to do this? We're going to proceed in 3 steps. We're going to first set all of the exogenous variables back to their 2002 levels. The endogenous variables are going to stay constant. And what we'll do is we'll first work to understand the global savings glut. How much did the global savings glut contribute to the dynamics of the US net foreign asset position, holding all of these other variables constant? So what we'll do is we'll restore savings and asset issuance to their actual levels over time. And we'll reuse this demand system to recompute prices. And we'll see what would have happened to the US net foreign asset position. The next step will be, okay, keeping the demand parameters constant, what would have happened if you had the global savings glut and increases in central bank holdings? So we'll also allow the central bank holdings to return to their actual levels over time. Again, recompute prices and look at the US net foreign asset position. Finally, what we'll do is we'll restore the demand parameters. Demand with respect to the actual characteristics of the assets, the latent demand, and then the latent demand with respect to asset classes. So this is across asset classes. Well, once we've restored all of these variables to their levels over time, we'll be back at the data. But looking at what happens to the actual net foreign asset position in each of these scenarios allows us to attribute the long run trend in the net foreign asset position to each of these different possibilities. So here it is. What we're going to do first is show you the data, or the last step, which is the component where we turn all of the endogenous or the exogenous variables back to their 2002 levels. This is the trend that we've been looking at from the beginning of the talk. Now, if I set all of the exogenous variables back to their 2002 levels, we'll be at what I would call the baseline. That is, you would just stay at this minus 10% of 2002 GDP because nothing actually changed in the system. Okay, so what do? We then turn on asset issuances and investor savings, the F and the Q, to understand how much this difference between issuances and the amount of savings affected this position, keeping all of the other variables constant. What you see is that the US net foreign asset position in that case would have declined to about minus 76% of 2002 GDP. All right, so this is a dramatic widening relative to what we actually observe in the data. Next step I want to show you is related to the idea that prices are endogenous in this system. So you have changes in quantities. That is, you have an increase in investor savings relative to the amount of assets that are issued here. That drove some of this trend, but we also have downward sloping demand curves in this system. And so this increase in purchases also led to changes in the prices. So what we can do in this system is we can say, let's assume that we just looked at this actual value, but keeping prices constant. So look at what the net foreign asset position would have been with this global savings glut turned on, but don't allow prices to endogenously adjust. But what you can see is that in that case, we would end up at about minus 42% of 2002 GDP. The additional component comes from the endogenous increase or endogenous changes in prices in this system. Okay, what about emerging market savings versus developed market savings? Well, because we have the entire cross-section of portfolio holdings, we're able to decompose this, at least in terms of the private investor savings. What you see here is if we turn on just EM only, that private EM savings only would have lowered the net foreign asset position by a few percent. A lot of this comes from the developed market, at least private investor savings. Now, of course, the caveat to this is that a lot of savings that occur in emerging markets is through the central banks of emerging markets, at least when in the typical narratives of the global savings glut. So the next step is going to be, let's understand what would happen with official holdings. Unfortunately, we don't have disaggregated data by EM or DM of the actual central banks. All that we can observe is just the aggregate position of foreign central banks in a particular country. But what we can do is take our savings glut counterfactual and allow the reserves positions of these central banks, as well as the position of the US Federal Reserve, to change. And what you'll see is that official holdings actually lower the US net foreign asset position even more. Okay, the final step is going to be to restore the demand parameters, right? The characteristics of the assets, the latent demand, and the latent demand with respect to particular asset classes. What you see is that going from this official holdings line takes us back to the data. These demand shifts capture, say, changes in allocations from both these observed and unobserved characteristics. And you can think of these as changes in the demand for certain assets that can't be attributed to changes in actual price. These demand shifts largely offset this large decrease in the US foreign official holdings position. Okay, so the last exercise that I want to talk about here is to try to get closer to this notion of exorbitant privilege that has been talked about in the literature. So the last exercise that we actually do in the paper is we ask the question, how much additional long-term debt can a particular country issue until the yield on their long-term debt increases by 1%? The idea here is to try to understand, okay, how much privilege does a particular investor or a particular issuer country have in terms of the demand with respect to their assets? So what you see here is I've taken the G10 and I've just ranked by billion US dollars of debt that can be issued such that the yield increases by 1%. Okay, what you see here is that the US could issue $1.6 trillion in additional long-term debt until the yield increases by 1%. Next up is Great Britain, then you've got Germany, Japan, and so on. Now, maybe this isn't the right scaling in your mind. It's because this takes into account exchange rates. Of course, everything's in US dollars here. You could do this as a percent of domestic GDP. What you see is actually quite interesting. If you do this as a percentage of domestic GDP, you see that actually Great Britain turns out to have the largest amount that they can issue until their yield increases by 1%, whereas the US ends up down here for about 7%. Okay, so let me conclude here. What we've done is we've adopted a demand system approach to examine the global imbalances in the US net foreign asset position, in particular the portfolio position. We showed that the global savings glut and official holdings both contributed to the widening of the US portfolio imbalances, whereas these shifts in demand of investors offset these large increases that occurred due to the savings glut and official holdings. Now, these countervailing forces aren't directly observable in the raw data. And so using this structural approach allows us to better understand jointly how various forces that have been talked about in the literature affect this key quantity, the US net foreign asset position. So all in there, we're looking forward to Adrien's comments.
Thank you very much, Robert. And so the discussant is Adrien Verdelhan.
Thank you. Can you see the slides?
Yes.
You hear me? Cool, excellent. Thank you very much to the organizer for asking me to discuss this paper. I really enjoyed reading it. I was told that I should not summarize the paper, not talk about the paper. So, okay, I'm gonna skip that slide just to tell you it's a really cool topic. They have a wealth of data and some pretty provocative results. So, okay, I skip that and I immediately go to my discussion. And so my discussion has 3 points. First, basically 3 suggestions. One is a suggestion about the data to try to raise the bar a little bit and show us the data slightly differently. The second point is about the identification of the demand versus supply. And the third point is about the simulations and the kind of assumptions we need to interpret those. So why is it a great topic? Well, I'm standing in front of it, but it's the net foreign assets position that Rob showed you. Here I'm looking at all the assets, including FDI and everything. And as you can see, okay, as you know, the US runs a trade deficit year after year. You see the cumulative current accounts going down, down, down. But the net foreign assets is also becoming very negative. But you see this big difference between the net foreign assets and the cumulative current accounts. And that's a point that Hélène and Pierre-Olivier made a long time ago. We have very interesting valuation effects to study here, and I'm going to come back to this point. I also want to highlight something that actually Matteo pointed out to me. Look at what happened in the last 2 years. with this really strong deterioration of the net foreign assets position of the US. I think there is something here to study, and the sample in the paper stops in 2016. I think adding the next 4 years is going to be really, really cool. Okay, that said, here's the kind of data they have to play with. I'm looking at the aggregate at the US level. So it's kind of the balance sheet of the US, if you want. On the left-hand side, assets. On the right-hand side, liabilities. First row, equities, and the second row, bonds. And as you know, the US borrows a lot of money from the rest of the world, and the US invests in foreign equity. Okay, so we all know that. Now, what we're going to do is that we're going to look at the changes in those positions, not just at the aggregate level, not just the US versus everybody in the world, but at the bilateral level, the US versus the UK. Year by year, the change in those positions. So my first suggestion is to do that with a little thing on top. Think about the position, the assets position of the US versus the UK. If the equity position increases, it's either because the US invests more in the UK or because the value of the UK assets went up, right? Okay, we can look at those two components, and actually we can even be more precise, not just the flows versus the valuation, but when we think about the valuation, what is coming from the exchange rate versus what is coming from just the value of the stock market in the UK, just to take the example of equity. And so what I'm showing you on this simple graph is, again, the balance sheet, assets on the left, liabilities on the right-hand side. But now I'm looking at changes year after year over pretty much the same sample period as in the paper. And what you see, I think, relatively easily graphically, is that when you think about equity positions, a big change in big drivers of those changes comes from the valuation thing, the red bar, right? And so you could decompose those red bars again into exchange rate versus price changes. If you think about debt, it's mostly about flows. Okay, so we have two different drivers, if you want, of those positions. It would be nice to know what the model says. Now, by definition, by construction, the model matches all quantity and prices. So at the aggregate level, I assume it's going to look like this if you have the right set of prices, right? It should. But at the aggregate level, I don't have the decomposition country by country. So I like to know, when we talk about the exorbitant privilege, who is paying that to the US? And I think the model can tell you that if you get into this kind of decomposition of valuations versus flows. So that was my first point. My second point is about the point that actually Rob made. As soon as we regress prices and quantities, there's always someone in the audience who says, oh, you could also regress quantities and prices and vice versa, right? Sure. And the problem is, of course, that even if the residuals of our two equations, like eta and epsilon, are uncorrelated, we are in trouble, because we can measure the volatility of the prices, the volatility of the quantities, and maybe their covariances, but that's 3 moments. And you see in the little equation system that I have here, I have 4 unknowns. So there's no way you can estimate this, right? Maybe state I can give you something, but it's a bit random. So that's of course extremely well known. And the way we usually address this is by coming up with an instrument. So what are we trying to do? I just relabeled my 2 equations, demand and supply. Of course, there's nothing deep at this point going on. The idea of the instrument is just that you have a set of variable, the vector variable xt, that's driving both the demand and supply curves, but somehow you can find one of them, and I'm going to call xt subscript k, and that one is going to shift the supply curve, but is somehow uncorrelated to the demand curve. And I know it's like I'm just repeating first year graduate course, right? But it kind of helps me to just go back to some very simple and basic thing like this. I should find an exclusion restriction. It has to be that one variable has no impact on the demand curve, and that same variable has some impact on the supply curve. And when you look at the way it's done in the paper, because of course they know this, right? They explain that they start with some exogenous characteristics like GDP, bilateral distance, investor fixed effect, on-country dummy, and then they solve somehow the system, use the magic of the market clearing mechanism, and then come up for some exchange rates and prices are going to be used as instruments. But when you read it, it's not obvious that it's going to work, right? I believe it's going to work, but like, exactly how is it going to work? So my second suggestion would be to just, again, go back to the basics as I just did, and do what Hélène did in a presentation. Show us the first stage, the relevance condition. It's completely fine if the instruments are built in some sense by the model, but once they are built, they exist. So show us that the instrument explains some variation in quantities. What I have in mind is a simple first stage graph that you see in every corporate finance presentation. There's the thing that should move, and then there's an instrument on the horizontal axis and some kind of cute bin scatter plot. Let's just do this. And then let's go for the exclusion restriction. Why doesn't the instrument change the demand curve? And to me, it's not obvious. I mean, maybe because I'm clearly not an IO person and I don't know this literature well enough, but I was trying to think about in the model, take out all the log it and exponential or whatever. In the model, what is driving, for example, the US holdings of foreign equity? And I can see an equity fixed effect. I can see some expected returns like I would have in any partial equilibrium portfolio problem, and those expected returns seems to come from the book to market ratio and the exchange rates. And I can see a bunch of assets and country characteristics, market value, book value, the 3-month and the 10-year interest rates, inflation, GDP per capita, sovereign default risk, trade centrality. I think I have almost everything at this point. And then there is the thing that is the residual, the thing that we don't explain. And then we call the US a latent demand for equity. And we have even a latent demand for equity in each foreign country. But when I see this long list of things that could be driving both prices and quantities, I'm not sure which one is not driving the demand, which one is driving the supply curve and not the demand curve. To me, it's not obvious because I think I could almost come up with a story for GDP, inflation, even what is the dummy? An investor could be more risk averse than another one, even at the country level. That may have some implications for everything we see both on prices and quantities. So I think here the exclusion restriction is always there, of course, the very difficult part to argue for, but just a little bit more explanation would be really, really nice. Okay. My last point, my third and last point, it's about the simulations. What do we do after estimating the model? Because it's amazing to be able to estimate this model on so many countries with this kind of, again, this wealth of data is kind of, wow, cool. So we want to use it. And they use it in 2 different experiments that Rob mentioned. The first one is to assume that all agents maintain their 2002 holdings throughout December, and then you relax this assumption for a different set of agents, one by one. And each time you do so, you solve for the equilibrium prices and the portfolio allocations. So that's actually a pretty cool experiment. The second one, as Rob mentioned, is let's look at the amount of debt that has to increase in order for the interest rate to increase by 1%. And I think it has to increase by more than 3 times what it increased before in order to have this kind of increase in interest rates. By the way, it would be cool to compare this to what all this sovereign risk literature in following Eaton and Gersowitz would actually imply, because in this kind of models, a 1% change in exchange rates could come with a lot of more debt. But we can talk about that. When I think about those experiments, the first thing that comes to mind is the Lucas critique, right? So if you remember the Lucas critiques, 1976, Lucas give it in the context of inflation and employment, and there's negative correlation between the two. And he says, well, government shouldn't try to create inflation because as soon as the governments do that, firms are going to change their expectations about future inflation and it's going to change their firm policy. And I'm wondering if there's not a little bit of the same that could be at play here. Well, if you go on with the inflation example, if the government produces a lot of inflation or a lot of money, a lot of debt, you would assume that actually people are going to price this debt differently. The default risk could actually become very important, and the increase in interest rate could be even much bigger than what we've observed over the previous 20 years in this sample. So where does this really show up in the way the simulation is done? I think, if I understood correctly, not sure, but if I understood correctly, we are assuming that the impact of each characteristic on the portfolio choices does not change across regimes. So you have one regime defined with a set of investors, for example, doing something, and we assume that the estimation that was run with all the investors, everybody else, and the full sample is still valid. And so is it possible? For small changes, I think I could certainly make a case that maybe investors are not going to change the way they view each characteristic. Maybe when I see a large firm, still a large firm, even if it becomes a little bit bigger, or if the government prints a lot of money. It's like there's no link between the two. But when we think about large changes, I think it's kind of a stronger assumption to assume that people are not going to revise the way they think about allocating their assets and how they think about each characteristics. Even if we actually were to re-estimate the importance of each characteristics, it's not obvious that the latent demand thing that on the other assets would not change. So I think there's a big kind of a big question here. I don't fully know how to address it, but that would be, I think, a really nice way to make the paper actually clearer on this. So to finish on time, it's a very interesting topic. It's a great paper. I learned a lot by reading it. I'm excited to read this one and the next version if there is one. And I just have three simple suggestions. First, tell us more about the flows versus the valuation changes. You can do this. So just give us the result. I think the results are already there in your simulation. On the identification, I would say let's go back to the basics. Show us how powerful the instruments are. Explain why they are the ones we should use. There's such a large literature. So many people are just spending their lives on this. It's important to address them. And on the simulation, let's explain how it addresses those different, basically the Likas critique in different settings. Thank you very much. I stop here.
Great. Thank you very much, Adrien. It was a great discussion. Rob, I'm going to give you a chance to reply.
Yeah, no, thanks for a lot of really helpful comments, Adrien. I guess I can talk specifically kind of about each of your points. So on the first point on quantities versus prices, yeah, that's the next step for sure. Right now, we kind of show the one aggregate graph there for the savings glut where we set things to 2002 prices, but we should do it in aggregate and make sure that that is consistent with the sorts of patterns that we see that like Helena's documented with capital gains versus quantities and understand that more. So it's certainly the next step there. On the identification, yeah, so we don't have it there, but we can show you more. The first stage is actually quite strong in this setting. So we don't have like a big concern about that, but we can certainly walk through more on which of these. And perhaps I think another thing to do would be some robustness with respect to the exogenous characteristics that we use for the instruments in the first place to kind of see how that works. The third is a tougher point in the sense that, look, one thing that we can do is try to see how stable the demand with respect to characteristics of different investors are over time. Now, that doesn't directly address the Lucas critique because the concern is, of course, that when we're doing the counterfactuals that that might change. So I think the next step in part of this agenda would be to try to endogenize the plausible things in the context of the model, right? So what you do is you have the actual demand curves, so you have an interesting demand side, but then you have to start to endogenize what happens on the supply, whether it be something that happens with the issuances by, the governments or something about inflation. But that I think to fully address that point, in our setting now, it's very much we do have to take the demand curves as structural to be able to estimate these things. But I think you can derive some of these from more first principles, perhaps going forward.
Okay, well, thank you so much, Rob. So we are actually out of time. So I'm just going to conclude then, and I'd like to say a big thank you to our presenters, and especially a big thank you to the wonderful discussions today. So that's it. Hope to see you all soon. All right. So thank you.
Thank you.
Thank you.